A Reserve Bank clampdown restricting low deposit home loans is now in force. The bank made the move in an attempt to reduce risky lending and to cool the property market. The result has been reports in some centres of desperate buyers with expiring pre-approved low deposit loans flooding open homes and auctions. Real Estate Institute of New Zealand Director Nidd is here with a local perspective. Good evening.
Good evening.
Now tell us exactly what the Reserve Bank has done here.
Well, it's quite simple really. No more than 10% of the bank's lending, of their total lending on housing, can be to people with a deposit of less than 20%.
Now what does the change mean for home buyers?
Well, it means that some will have to save for a bit longer because obviously what may have allowed them to get into the market may not now allow them to. So they'll have to wait a bit longer. They may have to reassess what they're looking for. So if they were looking to buy a house at $300,000 and their 10% deposit obviously was going to buy them, they were going to have 30% towards that. They're now going to need 20%. So they're just going to have to either perhaps look at something a bit further down the market, or they're going to have to look at topping up that deposit, and this is where what are referred to as second or third tier lenders come in, where they may be able to loan them the extra money, or I think there'll be quite a lot of pressure on families to help out with topping up that deposit.
Now this is only, of course, the first day that the change has been in effect, but there has been a bit of a lead-up. What are you seeing in the market locally at the moment?
I don't believe we can make a real comment yet. I think it's too early, and of course this last weekend was the first weekend of school holidays, and the numbers out looking, we find out always a bit less during the school holidays. So I think we need to give it 2 or 3 weeks before we can really comment on the effect that we're seeing.
Are home buyers themselves commenting on the change at all?
First home buyers are a little bit anxious, especially those who have had pre-approvals and perhaps need to go back and get pre-approved again.
Now what about people who obviously have one house under their belt? They can still go and buy another house with 10% deposit. Is that still the case?
No, it's the total book of lending. So the bank, they may be more likely to get, if they've got a good credit history and a good loan history, even if they only have 10% and not 20%, they may be looked on a little more favourably because the bank knows their history. So as I said, 10% of the bank's lending can still be to people with 10%, so they may get looked at a little more favourably to be allowed to be part of that 10%.
Does the Real Estate Institute have a view on the changes?
Well, we lobbied hard to try and get some consideration taken of the regions and the fact that the excessive rise in house prices is not happening in the regions. The only 2 areas really where we're seeing this is Auckland and Christchurch. So it's unfortunately been a one-size-fits-all approach by the Reserve Bank, and we were unable to have that taken into account.
So the Institute's stance would be that the market was not overheated overall? Overall,
no, and certainly not in Dunedin, which is what concerns you and I and the people who are watching.
What do you think the long-term effect of this change will be?
Look, I think it could slow things again slightly, and I mean, keeping in mind that in August there were only 162 sales in Dunedin, in the city itself. To put that in perspective, in 2006, at the peak of the market, in August there were 244 sales. So, you know, the volume of sales is already back by 30%. And we've seen very little in terms of price increase between 2006 and now. So it's really unfortunate because we have room for growth, and we have room for growth both in volume of sales and in the value and the median price.
Real Estate Institute of New Zealand Director Nidd, thank you very much for your time.
Thank you.